All right, welcome back. February in Times Square. It's almost Valentine's Day, three-day weekend coming up. The love is in the air. The love on the set tonight, that's for sure. And definitely love in Washington, D.C. The stimulus package clears the House. The Senate preparing to begin their vote. It's expected they will easily get to 59 votes. They need 60 to get it done. Again, the surprise here, of course, would be if they do not clear 60 votes. Hampton Pearson on that. And again, we'll check in with him around 5:30 when the voting gets underway. We'll set aside some of the frustrations of the past week in the financial markets to turn our attention to what was the epic trade of 2008 and something that has quickly gone by the wayside. Oil. Let me refresh your memory. Take a listen.
We think that in 2008, the average price per barrel of crude is about $115 or $120. But for next year, we think it could be several dollars above that.
The oil prices could well be many hundreds, maybe $500 a barrel within something like 5 years.
In 10 years, you're going to have $300 oil. Maybe higher, I don't know. If we continue to drift like we're drifting, you're going to be importing 80% of your oil. And I promise you, it'll be over $300 a barrel.
Well, it's a long way from here to $300 a barrel, my friends. Matt Simmons joins us from his offices in Texas. You can see the crude chart. You can picture it in your mind. Matt, what happened to $500, $300, what happened to that conversation? And are we kidding ourselves? Are we complacent right now because of the crisis and thinking that that threat has actually gone away?
I think absolutely. It's been astonishing to watch the dynamics of the energy markets. It was astonishing to me to watch the first 6 months of last year when oil prices, having gone up tenfold in the previous 9 years, kept marching up from 96 to 147, and all through that first 6 months there was every lame excuse in the world as to why this wasn't real. Then it kind of it settled out and kind of created a nice steady trading range. And the 22nd of September, it was like we banned the use of oil forever, and in 3 months it fell by 74%, which is the single sharpest, fastest drop we've ever had. That's kind of been bouncing around the bottom ever since then, and now you can read daily about people guessing how bad demand is plunging and how bloated our stocks are. The reality is we could not grow our supply as oil in the last 5 years went from sort of 50 to 147. We had every rig in the world working. Something really basic was going on. Now we've sealed the fate because we are laying down drilling rigs. We are canceling projects. So I think the big issue is not how modest the demand changes might be, but how plunging supply could be because of these prices. And so therefore, watch the oil prices at some point come soaring back and maybe go into some very dangerous territories.
Matt's argument, Joe, is that we're tightening a noose around ourselves here in this quiet period, such that if and when demand comes back, it's going to be worse than it was the last time around. Do you buy that?
Absolutely. I think infrastructure is antiquated in some of the oil-producing nations, and I think that capital expenditures are obviously going to decrease. But, Matt, my question for you was, what do you make of the front of the board being worth $36 and you move just 9 months out? The price is $15 above that. I mean, that obviously represents a massive inventory overhang that may take years to work off.
Hang on one second, Matt. I just want to make sure that everybody at home understands what just happened. You're saying that there's so much supply right now, Joe, that the difference between the price of oil today and the difference even a few months from now is much bigger than it would normally ever be.
Absolutely.
And you argue that's a reflection of a massive supply glut of oil right now. Is that what's going on, Matt?
I wouldn't think so. I think the big news in the last couple of weeks is that many of the very important key crude grades around the world that are not subject to relentless pressure on the NYMEX if you have paper barrel liquidation. I mean, the Tapis grade, which is the premier grade in Asia, got over 50, I think $51 a barrel earlier this week. Brent has been $10, $12 a barrel above current near-month WTI. The next month out WTI has been $7 or $8.
So, Matt, are you suggesting then the NYMEX WTI really is not the benchmark for oil?
No, it's a very phony price right now.
I don't think it is. I mean, if you look at the way the world, 2/3 of the world trades off of the price of Brent, WTI is not the standard. And I actually, if you look at the prices of Brent over the last 3 to 4 months, they've actually bottomed and started to build a bit. I'm on Matt's side on this one, by the way.
I just been trying to prevent the audience for this show going down to 3 to 4 people who understand what ever you all are talking about.
No, it's a pretty arcane subject. There's not a lot of people that understand it.
Fair enough, but there's a lot of people that would like to understand it, and part of my job is to make an effort to try to do that, which means fewer acronyms from time to time. If you were to look at a trading position, from a long-term standpoint, is it unreasonable to buy oil in the 30s at this point if I believe, Matt, what you argue, which is that we are failing to actually support our energy infrastructure such that if and as demand comes back, it'll be even tighter supply than it was the last time around?
I'm actually arguing something far more important, is that if demand basically slides a little, it will be irrelevant for how much supply we're going to lose, because the industry doesn't work at these prices. That's what's astonishing. 3 or 4 years ago, most of the pundits thought that $40 oil was just preposterously high. Now, all of a sudden, the oil companies are starting to realize they can't do business at this price. So supply will drop dramatically. Our stocks are so bloated, they're basically back to where they were in May and June 2007. That's not a lot of extra inventory. Our finished motor gasoline inventories are lean as can be, so we are not out of the woods by any stretch.
All right, Matt, a pleasure. We will talk to you soon. Enjoy your weekend. We're back as the Senate prepares their voting on this stimulus package. Again, they think they've got an easy ride to 59 votes, and then it gets interesting. Hampton Pearson with us live after the break.